How to analyze a real estate deal in 5 minutes. Most real estate investors are making offers on properties they should walk away from. And they don't even know it. I'm about to show you the exact 5-minute formula that separates the deals that make you money from the ones that drain your bank account. And you can run this analysis on your phone right now. Let's go. Okay, here's what most people get wrong. They fall in love with a property. They see a house, imagine their future in it, and suddenly their brain stops doing math. Stop doing that. Real estate is a business, not therapy. We're running 5 numbers in 5 minutes. That's 1 number per minute. And if any of these numbers suck, you say no and move on. The first number, purchase price. This one seems obvious, but people still mess it up. You need to know exactly what you're paying, including all closing costs, not just the listing price. Real example, a house in Austin, Texas is listed at $320,000. Sounds clean, right? Wrong. Add in your realtor commission. That's usually 6%. Your title insurance, your inspection, appraisal fees, property taxes prorated. Suddenly that $320,000 house actually costs you $345,000 out of pocket. That extra $25,000 matters later. Write down the total number, not the listing price. Number 2, monthly rental income. Here's where I see people get unrealistic. They think because a house could theoretically rent for $2,000, it will. No. You need to look at actual comparable rentals in that exact neighborhood. Not the optimistic listing. Not what your cousin said his friend got. Real data from Zillow, Apartments.com, or local property managers. That Austin house we mentioned? It's in a decent area. The comps show similar homes renting for $1,750. So use $1,750, not $2,000, not $1,800. $1,750. Number 3, operating expenses. This is where deals die and investors learn expensive lessons. Add up property taxes, insurance, maintenance and repairs. For most single-family homes, assume maintenance is 1% of the property value per year. That's $3,450 annually on our $345,000 house. Property taxes in Texas average 0.62% annually. That's about $2,000 per year on this property. Homeowners insurance runs about $120 to $140 monthly. Call it $1,500 per year. Visual expense breakdown table appears. Maintenance, $3,450. Property tax, $2,000. Insurance, $1,500. Vacancy, $1,050. Total, $8,000. Also account for vacancy, even with good tenants. Factor in 1 month of lost rent per year. That's about $1,750 on this property. Your total annual operating expenses, roughly $8,000. That's $667 monthly. Number 4, cap rate. This is the most important number most beginners don't understand. Here's the simple version. Cap rate equals annual net operating income divided by purchase price. So take your monthly rental income, $1,750, multiply by 12. That's $21,000 per year. Subtract your $8,000 in operating expenses. You've got $13,000 in annual net operating income. Divide that by your $345,000 purchase price. Visual, animated calculation appears. $21,000 to $8,000. Divided by $345,000 equals 0.0377 equals 3.77%. You get a 3.77% cap rate. Here's what that means. Your money is working at a 3.77% annual return. Compare that to putting $345,000 in an S&P 500 index fund through Fidelity or Vanguard. you'd get roughly 10 to 11% historically. That deal is worse than the stock market. Pass on it. You want a cap rate of at least 6 to 7% for single-family homes to justify the work and risk involved. Number 5. Cash flow. Last check. Take that monthly rent, $1,750. Subtract operating expenses per month, $667. You've got about $1,083 per month in positive cash flow. That's the money in your pocket after all bills are paid. Is that worth your time managing a rental? Only you know, but at least you know the real number. Visual. Cash flow summary displays $1,750 rental income minus $667 expenses equals $1,083 monthly cash flow. Here's what you do right now. Find 3 properties in your target market. Run this 5-minute analysis on each one. You'll immediately see which deals are real and which ones are traps. Real estate can make you money, but only when you treat it like a business and run the numbers first. If this helped you, smash that subscribe button right now. We drop videos every single week on real estate, investing, and building actual wealth. And turn on notifications so you don't miss it. The deals are out there. You just need to find the right ones. I'll see you in the next one.